Hello, welcome again. We are going to be covering chapter 4, which is the completing the accounting cycle. So in this chapter, let me get this going here. Okay, in this chapter, you're going to learn about a few more concepts that are necessary to complete the accounting cycle. So far, you have learned how to journalize transactions in tabular form and using T accounts. You also learned how to obtain a trial balance and make adjustments, which in turn allowed you to obtain an adjusted trial balance. And then from the adjusted trial balance, you came up with the financial statements. So I'm going to show you a alternative format that you can use in order to complete all of the steps that I just mentioned. Here's an option for you. This is a worksheet that can be used in the adjustment process and for preparing financial statements. So this worksheet has several columns, as you can see, and this is on your textbook. I'm just grabbing the complete worksheet. I believe it gives you 5 different illustrations showing you how step by step how they came about this whole entire worksheet. But I'm just taking the completed worksheet and explaining it to you. So it has several columns, beginning with the accounting titles on the first column, and then the trial balance column. And this is completed on an Excel worksheet. You learned how to prepare a trial balance in Chapter 2, which displays the accounts and their balances at a given time. So if you need to refresh your memory as to what a trial balance is, go back to Chapter 2 and you will see that this is just a copy and paste of that trial balance, except that we put it in cells in the Excel sheet. And so this information on the trial balance, if you go back to Chapter 2, you will learn that it was gathered from the ledger. And in this worksheet, you would just transfer the information from the trial balance, like I said, into the first 2 columns, which are the accounting titles and the debits and the credits from the trial balance. Okay, in Chapter 3, you learn how to make adjustments. So whatever adjustments that you made, you record that in the adjustments column here as either debit or credit. And then you also learned about the adjusted trial balance in Chapter 3, which is simply finding the new totals on each account based on the adjustments that you recorded. So, for example, here we have the cash account. In the trial balance, we had a debit of $15,200, and there were no adjustments made. See that these 2 cells are blank. So your new adjusted trial balance will remain the same as a debit for $15,200. But if I go down to supplies, we began with a trial balance and the debit side for $2,500, and then we made an adjustment for $1,500. Another way to explain this to you, like in your homework assignment, they gave you, oh, you had a total of supplies for $2,500, but at the end of the month, you only had supplies on hand equaling $1,500. I'm sorry. That means that you had to make an adjustment. And so you notice that we have a debit here and a credit here, on a debit on the trial balance and a credit in the adjustment balance. So what you would do to come up with the new adjusted trial balance is you would subtract 2,500 minus 1,500 equals 1,000. Okay, that's when you have a debit on the trial balance and a credit on the adjustment, or vice versa, a credit on the trial balance and a debit on the adjustment. So what happens when you have both a debit and a debit on both the trial balance and the adjustment. Let's see if we have one here. We don't, but we have the opposite, the vice versa, which is we have a credit on the trial balance and a credit on the adjustment. In this case, you do not subtract, you would add to come up with the new balance. And let me see if this is correct. Yes. So if you notice here, in service revenue, you have a credit of 10,000 and you made an adjustment. You made two adjustments, one for 400 and one for 200 on a credit side as well. So you would add these two amounts, which will be 10,000 plus 400 plus 200, which is 10,600. So to explain to you again, you get the adjusted balance by either adding or subtracting the trial balance and the adjustments. And you subtract when you have a debit on the trial balance and a credit on the adjustment, or vice versa, a credit on the trial balance and a debit on the adjustment. And you add when the trial balance and the adjustments both land as either debit or credit. In this case, we have two things here for two credits for trial balance and adjustments for service revenue. So we add those two amounts to come up with a new adjusted trial balance. Okay? So once you have the adjusted trial balance, you will have the information that you need in order to complete the income statement and the balance sheet. Okay? Remember that income statement, and if you need to refresh your memory, you need to go back to and read the chapters to refresh your memory, or go back to my lectures. Income statement asks for revenues and expenses in order to determine if there is a net income or net loss. And that is the reason we would only carry over the revenues and the expenses. As you can see, we have in the income statement column, we have a lot of cells that are empty. But we start recording the balances or carrying over the balances for revenue. See, we had an adjusted trial balance of 10,600, so you just carry it over to the credit side. And you look for all of the expenses. We have salaries and wages expenses. If you go to the adjusted trial balance, you see it that is a debit for 5,200. So you carry it to your income statement as a debit for 5,200. And you do the same for each of the expenses that you see on this trial balance, okay? Now, remember that the totals for the revenue and the expense accounts will determine your net income and net loss. So that is why you have the net income here at the very bottom, okay? Now the balance sheet accounts will be the assets, the liabilities, and owner's equity. If you will go back to the chapters, you will see that the balance sheet requests for you to categorize the accounts based on assets, liabilities, and owner's equity. So you would carry over the balance based on those categories. All the assets, which is cash, supplies, prepaid insurance, all of that will be carried over, along with all of your payables, which are your liabilities, and then all of your owner's capital. Okay? In other words, all of the cells that are not revenue and that are not expenses will be on your balance sheet. And then you could just come up with the totals here because you already have an Excel file, and you could come up with formulas that would generate the totals for you. Okay, so this is just another way to document the process you have learned in Chapter 3. And I like this option because you have all the information in one Excel sheet. But if you are not an Excel fan or you feel a little intimidated, you don't have to use this process. You could just use the other process that you have learned in Chapter 3. Okay, so now what is left to do in order to complete the accounting cycle? Well, all you have left is to close the accounts or close the books. For those that work already in accounting or that manage some type of budgets, you will hear the keyword close the books, and you will learn what that means here. You will learn as you read chapter 4 that there are two types of accounts. You have the temporary accounts, which are all the revenues, the expenses, and the owner's drawings accounts, while the permanent accounts are all the assets, liabilities, and owner's capital accounts. Okay, and notice that we only close temporary accounts. You see this? You may ask, why is that? Well, you're gonna see that you could close these temporary accounts, but you never close permanent accounts. So here's why. Well, let's say you close the books at the end of the year, which is usually what, as accountants, you will need to do that at the end of the year. Okay, but you are not going to go out of business. You are going to continue the business as usual the next business day on the new year, correct? Well, if that's the case, if you're going to continue running your business, do you think it's wise to close the assets, the liabilities, and the owner's equity, the owner's capital accounts? Do you think that's wise? By closing the books, what it means is to zero out the accounts. So, no, you do not want to close those accounts. You only want to close the revenues, the expenses, and the owner's the owner's drawings, because you want to know how much money you made on that particular year or how much money you lost in that particular year. And then you also want to know how much of that money was withdrawn by the owner. Remember the owner's drawings? And so the reason you need to know that is because you would eventually transfer whatever revenues you made in your business to owner's capital. That's the reason why you close these accounts, but not the permanent accounts. If your business is going to continue, you want to make sure that your assets accounts and your liabilities and your owner's capital accounts are continue to be open so that those balances are carried over year to year. But your temporary accounts will be closed down every single year so that you determine how much money you made, how much of that was categorized as expenses, and how much money you as the owner withdrew throughout the year for your own personal use. Okay? So how do you close the accounts? You will need to follow these 4 steps to the letter. What I mean by that, you just follow the directions that are stipulated in these 4 steps. It is very straightforward, and what I'm going to do is show you with an example that will help you complete your homework assignment. So, let's say in your homework assignment, you're going to have more accounts than these, but I just want to give you a straightforward example that you could follow so that when you go into your homework assignment, you know how to navigate the problem and complete it. Let's say that you are given this information. You have revenues totaling $15,000 as a credit. You have expenses for salaries and wages as a debit of $10,000. You have rent expense as a debit of $2,000. And you have owner's drawings as a debit for $1,000. And what you need to do is close these accounts. So how do you do that? Well, you follow those steps to the letter. Step 1 says, debit each revenue account for its balance and Credit Income Summary for total revenues. This step is telling you exactly what the name of your account should be, or the account title, and it's telling you, giving you directions as to what that balance should be. So let's read it again. Debit each revenue account. Well, what's our revenue account? We have a revenue as a credit for $15,000, and it's telling us to debit each revenue account for its balance. Well, its balance is $15,000, and it's asking us to debit, so we are going to debit revenue as a debit for $15,000. And then the other thing that it asks you to do is to credit income summary for total revenues. So your credit account title should be income summary, and your total revenue is going to be $15,000. Okay? And then you name the account to close revenue accounts. That's it for step 1. Step 2 says debit income summary for total expenses and credit each expense account for its balance. Debit income summary for total expenses. Okay, so what are our total expenses? We are given 2 expenses here: salaries and wages expenses and rent expense. And if you add those 2 together to come up with the total expenses, you'll see that it's $12,000. It's $10,000 plus $2,000. So you are going to debit income summary for total expenses. We know the total expenses is $12,000. So we're going to record that as a debit for income summary as $12,000. And credit each expense account for its balance. We have 2 expense accounts. There may be more in your homework assignment. So what you're going to do is you're going to credit each of those separately. Okay? Not all lumped together. You're going to separate them out based on their account title. So you're going to have a line for salaries and wages expenses. You're going to credit for $10,000, and you're going to have the next account title to be rent expense as a credit for $2,000. Notice that you're going to have a debit equaling $12,000, and if you add the credit side, it's also $12,000. Remember, they have to equal to each other. And this is to close expense accounts. That's it for step 2. Step 3. Debit income summary and credit owner's capital for the amount of net income. Debit income summary and credit owner's capital for the amount of net income. What is net income? Remember, net income is revenues minus expenses. We have revenues for $15,000, and then we just determined that our expenses equal $12,000. So $15,000 minus $12,000 equals $3,000. And it's asking you to debit income summary and credit owner's capital for the amount of net income, which we just determined it was $3,000. So we debit income summary for $3,000, and we credit owner's capital for $3,000, and that is to close net income or loss. If you end up having a loss, and you put down loss. And that's it for step 3. And step 4, you debit owner's capital for the balance in the owner's drawing account and credit owner's drawing for the same amount. Debit owner's capital for the balance in the owner's drawing account. Owner's drawing account is $1,000. So you're going to debit owner's capital for $1,000. And then you're going to credit owner's drawings for the same amount. Owner's drawings as a credit for the same amount, which is $1,000. And that is to close drawings. Done. You close the books. You're zeroing out those accounts. Once you do that, you're going to come up with a post-closing trial balance. You already know how to do a trial balance and an adjusted trial balance. The trial balance, you came up with the totals based on the ledger total and the totals on the ledger accounts. And then you made adjustments and you came up with the adjusted trial balance. Well, now you close the books and now you're going to have to come up with a new trial balance based on those new totals, okay? So I'm not going to really go over that because you should already know how to be coming up with new totals. It's the same procedure for trial balance and adjusted trial balance. It's just that now after you close the books, you come up with the new totals. Okay, so now you have completed the accounting cycle, and this is what the accounting cycle looks like. It's in your book. You learned how to analyze the transactions. And once you knew which accounts were affected by the transaction, you journalized it. Then you posted the transactions on the ledger account. You prepared a trial balance. Then they asked you to make adjustments, so you made adjustments as needed and prepared an adjusted trial balance, just step 6. Then you prepared financial statements. Remember, that was the income statement, owner's equity statement, and balance sheet. And then you closed the books, which I just went over that. And after you close the books, you complete the post-closing trial balance. And done. This is the accounting cycle. You start over and over again and go in this circle. Just an FYI, your project for this class will require you to complete this cycle. Okay, so that gives you an idea of what will happen for your project. I will give you some type of business, and we'll give you information, and I will ask you to journalize some transactions, post them on the ledger, prepare a trial balance, journalize some adjusting entries, then prepare adjusted trial balance. Then I'm going to ask you to come up with financial statements, and then I'm going to ask you to close the books and give me a post-closing trial balance. That will be your project. And that is all for this chapter. If you have any questions, just get a hold of me and we will get through this. Good luck to you. Oh, notice that this chapter or the assignments does not include a quiz. So just make sure that you don't get all if you have questions or wondering what happened to the quiz, just know that we don't have a quiz this week. Okay? Thank you for your time.